U.S. oil production is at the highest level in 17 years thanks to hydraulic fracturing in North Dakota and Texas, and the U.S. is brimming with spare gasoline due largely to weak demand. Meanwhile, the economy remains sluggish, growth in China is slowing, and the U.S. dollar is strengthened. Yet oil prices continue to trade above $100 a barrel, and gas prices are up. Logic would say greater supply of oil would translate to lower oil prices, but there's a catch. Turns out the industry didn't anticipate such a surge in oil production and doesn't have the pipelines in place needed to transport the oil from the fields to refineries to be turned into gasoline. That's caused oil to accumulate in certain areas of the country like Cushing, Oklahoma, a major oil trading hub, instead of being transported to the rest of the country. The result? While the stockpile of oil pushed down oil prices and gas prices in Oklahoma, it hasn't pushed down prices in the rest of the country. But as new pipelines are built, will oil prices fall nationally, translating to lower gas prices? Here to make sense of the puzzle is Mike Breard, energy analyst for Hodges Funds. Mike, welcome to the program. It's nice to have you.
Thank you, Jennifer. Nice to be here.
So why is oil still trading as high as it is, given that the new supply once tied up in Cushing, Oklahoma, is starting to hit the market, and given that oil output in the U.S. is the highest in nearly 17 years?
Well, the supply problems in Cushing have been improved lately. At the first of the year, we had over 50 million barrels in storage. And then even as late as the end of June, we had 49 million barrels in storage, with the latest figures under 40 million. So the switching pipelines to run away from Cushing to the Gulf Coast has enabled, and other changes, has enabled the Cushing oversupply to drop substantially.
But why hasn't that translated to lower oil prices, right? If you have supply that was once stowed away in Cushing, Oklahoma, that's now being transported to refineries finally, why isn't that translating to lower oil prices and then in turn lower gas prices?
Well, what has happened for years, we've had the Brent price, which is generally the international oil price, has been running $15 to $20 ahead of the West Texas Intermediate price. But in just the last few weeks, it's come down to just a couple of dollars. And instead of selling U.S. oil at $95 and foreign oil at $115, you're selling both of the oils at around $104, $105. So the foreign price has actually come down because of the higher U.S. production. And U.S. gasoline prices have gone up. I know that sounds kind of peculiar, but that's what's happened.
Right, and why is that though? Is it because U.S. gas is refined mostly off of Brent as opposed to WTI?
Well, one other reason is we've hit a record high in diesel fuel exports. We were selling over 1 million barrels a day of diesel fuel overseas. And that's just a recent increase. The U.S. refineries are, we're not allowed to export crude oil, but we can export refined products. And so a lot of that Cushing oil, in essence, is being exported overseas in the form of diesel fuel.
So in other words, it's putting pressure on international oil prices, Brent, which is the international benchmark, as opposed to WTI. And you've seen that spread, as to your point, that's narrowed. Would you expect WTI and Brent to continue trading roughly in parity?
Yes, they should. Now to put the gasoline prices in the U.S. in perspective, though, at the end of July, the average price in the U.S. was $3.65 per gallon. And then in early July, it was down to $3.49. Then you had the switch in oil prices, and now gas prices are back up to about $3.63, but they're actually no higher than they were in late May.
We've talked about the production side of things, but on the demand side, China is slowing. For the past 8 years, I've heard the bull's thesis for oil is that there's so much voracious demand for oil in China, but as growth has slowed in China, and by the way, also globally and in the U.S., why hasn't that put greater pressure on oil prices?
Well, the demand in China is slowing, but it's slowing from about 9% to 7%. And that's still a tremendous increase in their usage of oil. To put it in perspective, in the U.S., if you look at the population and the oil usage, it's running about 22 barrels per person per year. In China, it's 2.5 barrels per person per year. In India, it's 0.9 barrels. So in Japan, for example, it's 13 barrels per person. So if the consumption level in China and India rises just a little bit to come, within a third of what it is in the U.S., we couldn't supply all the oil.
So are $100 a barrel oil prices here to stay then for the foreseeable future?
Yes, there's two other reasons for that, though. One is it's getting more difficult to find oil. You're drilling in 10,000 feet of water, and it's much more expensive. And also the shale that they're fracking in North Dakota and Texas, the stuff is as solid as concrete, and it just costs more money to frack that. So as we found the easy oil, and as it costs more to find oil, you're gonna have to have a higher price. And then second, something that a lot of people don't look at, in round numbers, we're using 90 million barrels of oil a day worldwide. And if you just use, say, a 5% depletion rate, that means we have to find 4.5 million barrels a day just to stay even. People talk about all the new fields coming on stream in North Dakota and Texas, but they neglect to mention the depletion rate.
So then, Mike, how do I play this as an investor? How do I play the higher oil prices? How do I play the greater production?
Well, one good way to invest, one way that we like here at Hodges Capital is the offshore drilling stocks. More and more discoveries have been made offshore, and you need more and more drilling rigs to develop those discoveries. So this is a way to invest in the growth in the search for oil. Another advantage that a driller or a service company such as Halliburton or Schlumberger, another advantage they have is they get paid even with a dry hole. So if the hole comes out dry, you still have to pay for the drilling rig and the fracking and everything else.
So you like Halliburton and Schlumberger?
Yes, and in the offshore drilling group, there's companies like Atwood or Hercules, Insco. The whole group looks pretty good.
Mike, thanks so much for coming on the program and sharing your insight. I so appreciate it. Hope to see you soon.